Sounds good. Thanks, Irvi. So yeah, no, my name is Thera. I'm a multi-sector fixed income analyst at PIMCO. So I work on product slash portfolio strategy for the income and dynamic bond funds. And basically that's kind of like the defensive, more defensive funds that PIMCO has and very, very core traditional fixed income funds. So very excited to be here. And a little bit of background about me. I went to UCLA. I graduated in June of this year. I was formerly at BlackRock with Irvi. We shared the same mentor. So he was also in fixed income. So that's how I know Irvi. And yeah, I just moved to New York from LA, which was such a big surprise in a way because New York is so chaotic and I'm not sure that I'm doing everything correctly because everyone's always in a rush. But I really miss LA and SF and just how nice and chill everything is. Also the weather there is so much better. So really miss the West Coast. But yes, I will get started into my slides. So Irvi, do you want me to share slides or do you want to share slides?
You can do it.
Okay, I will share. Oh, I think you need to let me share slides.
Oh yeah.
Sounds great. All right. So let's get started. Oops. And then I haven't used slides in so long. I just use PowerPoint now. But yeah, so just I think I'll just start from like the very basics about like what is fixed income. So fixed income is basically a class of like, oops, sorry. Stop sharing. I don't know. Oh, sorry. It's my Citrix view. It's just because, yeah, my VDI. But yes, so fixed income is basically an asset class that pays out like a set level of cash flows to investors every like whatever it's kind of. I'm pretty sure everyone already knows this. So I'll just kind of speed through this, but it's basically every frequency. There's like a set frequency, so it could be quarterly, monthly, yearly. There's kind of a fixed interest rate or a fixed dividend that's going to be paid out, so a coupon, and then all these bonds kind of have a maturity date where the bonds will basically return the principal amount to the investors. Government and corporate bonds are probably the most common types of fixed income products that you've heard of. So I think you've all heard of like governments using bonds to kind of raise money, Moody's kind of raising like more localized funds to build bridges, highways, etc. Corporate bonds, kind of to raise capital for funding of a company, or like in M&A, there's also like debt capital markets, which kind of works on issuing debt to fund a particular project within the company or in conjunction with another company. So basically, I think everyone here already knows, but in a company's bankruptcy, fixed income investors are actually paid out before stocks, or common stockholders. And so technically investing in bonds would make it more of a safer asset class than investing in stocks. And so that's why there's a little bit of a traditional understanding that bonds would be something that people would invest in if they wanted a secure and consistent return. And so I would just go into the next page. So goals of fixed income investing. And then a lot of people I think already know, sorry, that fixed income is a little bit more geared towards, you'll see a lot of it in retirement, in pension plans, something a little bit more of, we call dampening the drawdowns in your portfolio. So it's something that will allow you to, even if you're investing very high risk into stocks, to complement your portfolio into adding more of a defensive mechanism in case those high risk investments do fall. You do have kind of a steady stream of income coming from this fixed income investment. And so kind of the three main goals of most fixed income investors will be capital preservation. So you want to keep the starting amount of capital that you have. You want the steady stream of income. So I'm going to go into a little bit more of this later, but one of PIMCO's best-selling funds, the income fund, is actually one of the best-selling funds because it's able to provide that steady stream of income. So you know that it's reliable, and especially for, I'm talking kind of fast, so please tell me if I'm talking a little too fast. But yeah, like the income fund has been doing very well over the past decade because it's able to provide that steady stream of income. And especially if you are a pension plan or a retirement, planner, or even like a financial planner, like having that steady stream of income that you can count on is something that is going to be very important. And so I think a lot of this is where it starts to distinguish a little bit more from the equity side, because in equities you have dividends, but that's a little bit more contingent on the company's performance. Whereas in fixed income, like the income fund, there's a flat set distribution that's going to be paid out monthly. And so this is kind of just irrelevant of whether or not the fund is performing positively or negatively. The fund is required to provide that distribution. And so you're going to get that steady stream of income no matter what. And so the last bit is also, it's less risky than stocks. I think a lot of people are hesitant to go invest in stocks, especially more risky stocks like meme stocks, as everyone's heard of, just because of how much risk there is into, losing your capital, or, having, I guess, not even just losing your capital, but going into negative territory in terms of you're going to have to pay an amount to cover that loss now. So I think a lot of people see fixed income as a way to get consistent returns, especially in later parts of life when you are not as willing or as able to take more risk into how you're investing in things. So in terms of fixed income, I think a lot of people would say that it is a little bit more traditional and in knock on wood, not as sexy as like stocks. But there are a lot of kind of, I would say, inputs into fixed income funds that do make it very interesting. And so I'll go into a little bit more of that later. And so, yeah, so very, very briefly, like this is benefits of just fixed income investing. So you have a diversification from stock market risk, and they're less sensitive to macroeconomic risk in the sense where, let's just say, there's an energy crisis in Europe right now, and if we just do ceteris paribus with no rate hikes and everything, the stock market is going to be incredibly volatile. People are directional views, outlooks, everything just looks very negative. But unless like the ECB is going to raise interest rates or something, the bond market is going to be relatively stable. And so that's kind of why people think about investing in fixed income in a volatile market. But obviously this is a different volatile market because rates are, hiking really fast. So that's just something that we will have to consider. And I'll talk about that a little bit more towards the end as well. The second one, like I said, capital preservation. A lot of fixed income funds traditionally go for absolute value returns, which means that they want that initial amount that they started with back. And it's not where stocks where you're, generally able to say, oh, if I don't get that principal amount back, it's going to be okay. I think one of the core objectives of many, many fixed income funds is that they get that initial invested amount back, because one, it's so much harder for them to recoup the losses if they do start to go into negative territory. And second of all, it's pretty much their selling point into keeping their capital intact. And so there have been a couple of funds that haven't been performing as well this year. And so one of the goals that they've had is capital preservation. And when they're not able to meet that, that's when investors are starting to withdraw their money. And so I think, having that as a core objective really defines why we should invest in fixed income rather than equities for people who would want to keep that initial cash. And then, like I said, income generation, it's very steady and very reliable, and it's fixed. So it's not like a dividend where, it's contingent on the stock performance. And muni bonds are actually exempt from taxes. But I think from my understanding, there are many more municipal bonds that are being issued now that are actually not tax exempted. And so for me, I was kind of wondering what's the appeal of muni bonds. And I think it's more of the duration side. It's like they're more short term compared to other government related bonds that might be like 10, 30 years. So muni bonds are usually for projects that are going to be in the next like 2 to 5 years. And so those would be appealing for people who want to invest in something that's short term. And then total return, like I said, like most fixed income assets want to generate attractive returns, but they also need a lot of diversification, and having a steady kind of flow into just like a government bond is not going to cut it. So they have a lot more of interesting, I would say it's very interesting in how they use swaps, options, and derivatives in order to kind of create this extra source of revenue into the fund. And so, yes, of course, with everything comes risk. There is risk in fixed income investing. And I think now is a very good time for me to just ask a quick question about what everyone thinks about passive versus like active management. If anyone has any like thoughts on those two.
Well, Thera works at PIMCO, so we all know the right answer here. But Hitesh also works at BlackRock, so you guys, we are here for this conversation.
Yeah, so I used to be working on part of the iShares component at BlackRock. So if you ask me, I actually really like ETFs and passive investment, but that's more for me on my personal end. But actually, so what I wanted to talk about today is in terms of passive and active management, the Bloomberg Ag is something that we look at a lot. Sorry, I'm not sure why I'm getting cough. We look at a lot in terms of the Bloomberg Ag. And as of June 30th, the Bloomberg Ag's duration has actually increased by about 70, well, duration risk, which is basically interest rate risk, has increased by about 77% since 2008. Unfortunately, I don't have those slides because they are in my VDI and I can't take them out, but I just wanted to talk through a little bit about that. And the ag has been comprised more of lower quality triple B, as many people would know, junk bonds into its composition. But at the same time, you are not getting compensated for the amount of risk that you are taking. And so now this leads us to the question where you have all these risks in fixed income. And so if you are investing in something that's supposedly really safe, then why are there still risks, right? And so fixed income, like every other asset class, has risk. And one of that is interest rate risk. Especially now in this environment, we can see that interest rates rising means that bond prices are going to fall. And so they have an inverse relationship. And so in a rising environment, you generally want to, be a little bit more conscious about the bonds you're investing in, because there's a very high probability that your valuations are going to fall in the next hike. But interest rate, movements cause a lot of volatility. And so when we think about interest rate risk between 2008 and 2022, it's gone up by about 77%. So having increased interest rates risk, we want to be compensated for, our ability to tolerate risk. And so it's actually become clear, if you guys want to read into it, that the Bloomberg Ag and passive investing is actually not as viable anymore in 2022, given how much interest rate risk there is, and inflation risk, actually. So that's a very good, and credit risk. So it's like the first 3 points. So the inflation risk, again, inflation is probably one of the bonds kind of most dangerous, like Achilles heel, because if there's high inflation, it just basically means that your fixed amount that's being paid out every year or every month or every quarter is going to be worth less, because the value of the money that's being paid out is going to be worth less in kind of the real terms, because the nominal inflation is so high. But there are ways to counteract inflation risk into your portfolio, and I will talk a little bit more about that in a bit. But credit risk as well. So if you invest in corporate bonds, then you take on credit risk in addition to interest rate risk. And so, like I said, with the ag, it's becoming more composed of like triple B bonds, which are very, very risky. And so you can argue that, oh yeah, but they're going to give us higher returns, but you're not actually being compensated as well from the ag. And so why would you want to take additional risk if you're not being compensated that well? And so another kind of more lesser known point, but I think it's becoming more prevalent now, is liquidity risk. And so if, the company is unable to sell that to find a buyer, then obviously, your bonds just kind of become a little worthless. And so you just want to make sure that the company that's selling the bonds has enough liquidity to keep going in its operations as well. And so with that, I'm going to go into sample asset allocation and fixed income portfolio. So this one, I'm actually a little excited to talk about. And so I work on 2 core portfolios. And so these 3 portfolios, I'm also very proud of my chart. So, but these 3 portfolios are actually, despite how similar they look, and they're all in fixed income, they're actually created for completely different purposes. And we can see that through their asset allocation composition. And this is actually one of the things that I wanted to talk about when we're investing in fixed income portfolios. And so even though the objective and the goal of, I would say, each investor and portfolio manager, the composition of each individual portfolio will really determine kind of what side of the fixed income spectrum you're looking at. And so I have kind of 3 portfolios here. DBF, which stands for Dynamic Bond Fund, is an absolute return, absolute strategy fund. And so basically what it means is that the guidelines are very flexible. You're given some money and you're basically able to do everything, because your most important objective is to get returns wherever you can find them. And so this fund, interesting enough, if you go onto the PIMCO website, you can actually see that they are allowed to go negative duration. So they can actually short duration. So they can basically short like interest rates. Like if basically, let's say this year, like shorting duration would have been a very good idea, because interest rates rising made their valuations, like their bond valuations, lower. And so if they shorted that, they would actually be able to gain from the valuations dropping. And so this fund is actually a very interesting fund because it did not short duration. And so now you're trying to see, oh, I'm trying to get returns where I can, but you're not actually taking the steps to get there, right? So what is it actually made of? So I'm going to go into each kind of portfolio in depth, just to highlight kind of how fixed income can be a very versatile tool in constructing portfolios as well. The second fund I want to talk about is total return. So I don't know if everyone has read The Bond King or has heard of Bill Gross, but essentially Total Return was Bill Gross's and PIMCO's flagship fund at one point, because it was just doing so well. And this was a humongous fund that has had so much outflow since he left the firm pretty much. So it's a very interesting fund that I think we can look into. It's known as a core bond fund, which means that it invests very heavily into core fixed income securities. And we're going to see why that's the case in a bit. And the last but not least is called the Income Fund. So the Income Fund is PIMCO's new flagship mutual fund, which pays out distributions every month, a fixed amount of distribution, which they've actually just increased. And so if we think about it, like all these funds technically serve a different purpose in a portfolio. And so if, let's say I am a pension fund, and I want something to be able to distribute to my investors every month, because we need to pay out, people who have, like they need to get like a fixed amount of payments every month, that I would invest in the income fund. But here's where it gets very interesting. So if we just look at the portfolio composition for the income fund, I don't know if I'm allowed to annotate on this, but I will try my best. So we can see very, very highly that this is securitized, which goes into like mortgage-backed securities, ABS, asset-backed securities, CMBS, commercial mortgage-backed securities, or other kind of securitized assets that have another type of asset that's the underlying. So these can be safe and risky at the same time, right? But a lot of it is securitized can also be, I'm not really sure if they group them together, but I believe in this particular graph they do, to be structured notes, which, convertible bonds go into that particular area, where it's like convertible bonds are, the bonds underlying is, I believe it's like you can convert it into like preferred shares for equities. So that's kind of where you can drive returns as well. And then you can also see that they have very high yields compared to the other two funds because they need to pay out that distribution. So they need to continue taking risks in their portfolio because they need to pay out something. And so, compared to the other two funds, this fund's going to have a lot more credit risk. And if you ask me to kind of maybe say you want to complement this fund with an equities portfolio, then that might not be a good idea because there's already so much credit risk in here. So if we look at risk as an overall metric, there's already a lot of risk. So why would you want to add more risk to the portfolio, right? And so if we can also look here, we can see some short duration instruments are very low. It means that income as a fund is focused on longer term, longer duration instruments where they're focused on looking at the longer game, kind of maybe being a little bit more flexible, nimble, just to get through this period of volatility. But their end goal is not to be able to profit from this particular time. Their end goal is kind of just to make it through. So you can see that like already the objective of this portfolio is so different from the other two. So if I just move back one to the left, we can see total return is like shorting short duration instruments. Like that's completely different from income where, they're adding a little bit of short duration instruments into their portfolio. Like in total return, they're actually shorting it. So that's their view that short term, is, they think it's going to go down even more. And that's why they're shorting short term instruments. But we can also see that they have basically no high yield exposure. And so they want to keep their credit risk down and focus more on investment grade kind of credit and looking towards opportunities that are consistent, but at the same time, provide a steady, I would say, stream of revenue, combining that with government related. So total return, you can almost say it's looking a little bit more towards a safety, a safety net, something that you can count on, can be reliable and produce returns when needed. Unfortunately, this fund is actually down like 15% this year. So their objective hasn't actually worked out that well, but I guess very similar to income, they're focused more on the longer game. DBF is probably my favorite fund and the most interesting out of all of the three, I think, because their guidelines are so broad that they're basically allowed to do anything that they want. And so you can see that they're kind of very little, they have very little conviction on government related bonds. And to be honest, as an absolute fund, that would be their mandate because they are looking for returns. And most of the time, government backed securities like bonds, because they're so safe, they don't really give you a lot of returns. And most of them could even be zero coupon bonds. And so as an absolute return fund, that's not what you're looking for. You want returns where you can find them. So securitized, they're emphasizing on like mortgage-backed securities, with the housing market doing very well. You want to emphasize on where you see you can find returns. You're looking at investment grade credit because, obviously the spread between high yield and investment grade has narrowed significantly. If you guys recall back to like maybe 2021, you can see that like high yields was probably one of like the best performing asset classes because interest rates were very, very low. And so high yields with its kind of additional yield, it was just like a money making machine, it was just making so much money. And so now with interest rates higher, we can see that, people have kind of cut back on like putting that extra risk into their portfolio, knowing that they can get a safer return elsewhere. Non-US developed, we can again see that, DBF is kind of willing to take risk into other countries. And so some non-US developed I can talk about could be, investing in other parts of the world like Europe, where they see opportunities. And that doesn't actually even have to be a long opportunity. They don't even have to see it as like we're going to go in here and buy bonds. They could even go short. And I think that's super interesting as a fund because you're able to access every opportunity, but it's more about how you're able to, strategize and go short, long, however they want to go for. And then we can see very, very clearly that they are 18% in short duration instruments. So you can kind of tell from their portfolio composition that they have very high conviction in kind of short term, looking towards opportunities in the near term rather than in the long term. And so, even in the same firm, even in the same kind of asset class, we can see that these three portfolios already have three very different mandates. And we can look at, trying to see if we can even use two to complement together, right? And so I don't know if anyone, I think this is also a good time for me to pause in case there are any questions, but I think maybe I can just ask a quick question, like if, you were an investor, which kind of two funds would you maybe like pair together and see kind of a lower correlation between the two funds that you think that they would do, a lower kind of like a similarity between the two funds and you think they would be able to complement each other. So I think I'm just going to pause here for a minute and see if anyone has any thoughts or if anything I'm saying is a little unclear.
What's the fund structure or investment vehicle for each one of these? Like, how do investors access each one?
Oh, they are all mutual funds, but I believe that total return and income have an ETF as well, like an ETF version of the fund. But yes, they are mutual funds.
Okay.
And then, yeah, I can talk a little bit about the distribution as well if you prefer that, but I'm not sure if that answers your question.
No, that's good. I'm just wondering if it
Okay.
was more like publicly available or if it was like you'd have to enter it privately or something like that. But
Oh no, these are all publicly available investments. I believe if there is also like a private income fund at PIMCO, but I believe that's more of like on the private side. Yeah.
got it.
Could you talk more
So,
about the distribution side of it?
Oh, the distribution side of the funds. Yeah, so I don't really take care of the distribution side of the fund, but I can talk a little bit more about it. So basically, as my role, I'm more of a portfolio strategist. So what I do is I work with as the account managers at PIMCO to incorporate funds into client portfolios. And so I kind of determine how each fund could have an impact or how that could serve their objective. And so let's just hypothetically, I'm working with a retirement like a retirement fund or a retirement advisor. We don't work with them directly, but then how would I pitch these two funds? I think that kind of just answers my question. So we can see very clearly that actually, I'll answer Irvi's question first. So basically, we kind of distribute through an intermediary, and then those funds from which the intermediaries go to distribute are pooled, and then all those funds are pooled into a mother fund. And so there's kind of like a overall fund. However, in Asia, that is a little different. So most Asian funds are put into what we call wrappers. And so they're wrapped under like a local bank, because I feel like some Asian countries, I believe Thailand is definitely one. I'm not sure if Singapore is one, but I know Malaysia is also one that you need to wrap the fund into a local bank fund. So basically we could have like a Thai bank selling, Global Opportunities Fund or something, but that's actually going into like the BlackRock Global Opportunities Fund. Or we can have like a, we can go with Thai, like one of the Thai banks I know is, if anyone's familiar, could be like Kung Thai Dynamic Bond Fund. And basically what that does is whenever a retail investor subscribes to the fund, which means they buy a unit of the fund, the bank pulls all of their money into a fund within the bank, and then the bank becomes an institutional investor into the fund. And so that's a little bit how it works in like different regions. There are, I think, different kind of ways that institutional investors invest around the world. So I think it just depends on which region you're on. But Irvi, I hope that answers your question.
Yeah, definitely. I've noticed that now that I've moved to Asia, that a lot of work here in terms of investing into fund managed funds happens through banks. So I think you very much said that correctly, because in markets like India, even like general Southeast Asia, it's very hard for individual investors to navigate the investing industry. So they tend to do this through their wealth management partners, private banking partners. So the fund I work on here as well, we have a lot of partnerships with banks across India, across Malaysia, Thailand, and things like that, so that we can get a lot of small investors pooled into one big investment, which the bank represents. That way, there's also benefit that the fund management company doesn't have to talk to each individual investor, and the bank sort of handles that aspect for us as well. One more thing that I wanted to add on the total return fund, which I found really interesting while working on that, was that the short duration part that's negative is also like equivalent to the leverage that they use. So the total return fund sort of amplifies its returns by borrowing money and using that as an investment. So it's essentially shorting money market, which is like shorting a repo, borrowing that money for a short amount of time, and then using that money to invest into like securitize any of the other asset classes. That way, it's able to get an advantage over other funds at PIMCO, and this is just like a general strategy as well that I found really interesting to look at, which means that from a portfolio management side, it gave a lot more flexibility for me to figure out what else we could be investing in.
Yeah, thank you so much for that clarity, Urvi. I definitely, I work on total return, so that was like super insightful for me. I barely ever touched total return, so I didn't even know that the short duration instrument was money market. So that's super interesting. So thanks for sharing that.
Do you have a sense for how big each fund is? I could probably look it up, but just off the top of your head.
Yeah, so DBF, I believe, is around 2 billion, I believe. Yeah, I think it was 2.7 billion. And then income is like 12, I believe. Like it's huge. It's a very, let me just pause here. I'll double check. My boss would want me to have this correctly. But let me just stop sharing for a second. Let me just double check. Yeah, I believe that DBF, I mean, I just looked this up yesterday. So is around 2 billion. And DBF has had, I would say, a pretty tough year. It was in a pretty tough spot, like I said, just because, yeah, it's 2.735 billion. My boss should be proud of that. But basically, it's had a pretty tough year because, like I said, it's one of those funds where it's just had so much flexibility into their guidelines that you're like pretty much allowed to do anything to make money. And it's like, how are you losing money when you're allowed to do anything to make money, right? And so basically, it's kind of like I believe they even have like a guideline for like 10% preferred securities. Like they can even invest in equities if they wanted to, but like PIMCO doesn't really invest in equities. And so I think DBF is a very interesting fund to look at because I think their AUM was actually halved like at the beginning of this year. I think they had like twice the AUM that they had last year. So it's more of like one of those funds where you think about what could have gone right instead of like what they did right. I think every like PM call I've been on in this fund has just been like, in a perfect world, we would have done this. And so it's kind of like, how do we strategize into going forward with this fund? It's like, okay, we've been wrong multiple times. So how do we get this correctly? And actually, that's a very interesting question that you asked, because there is a competitor fund from JP Morgan that alternates investing into two things. They are also an absolute return fund, which means they can find, like, they want to find returns wherever they can get them. And they invest in two things: cash or high yields. That's all they invest in. So literally this year, their portfolio is 70% cash. And cash has been doing like the best because it has no credit risk and no duration risk, right? It's just like the best performing asset class this year because equities are down, everything else is down. And so I think they performed in like the top quartile, like top percentile of all absolute funds. Like I think they were like the second best performing fund, just because like they just didn't have to invest in anything else. They just kind of waited for cash. But last year they invested in high yields, which was like one of the best performing like, fixed income asset classes. So like essentially this fund, in terms of like their absolute strategy, it's just alternating between these two. And like, if you ask me, I feel like that's actually really genius because it's like finding returns where you can get them at whatever point in time. So it's like, oh, if the market's doing well, then we will go into high yield. If it's not doing well, then we'll go into cash, because it's just basically like you're just alternating between two things, and it's like very hard to get wrong because you have very limited choices. Whereas with DBF, as you can see from the portfolio, it's like, very, 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 like very messy. Like it has a lot of asset allocation. And so it's kind of like once you start to invest into more things, then there's a higher probability that it will be wrong, right? And so that's kind of what happened this year with this fund. But yes, so for your question, so income is 11.3 billion. And then I believe it is, yes. Let me just double check total return. So total return, Irving, feel free to correct me if I'm wrong, used to be the biggest fund, right? I believe it used to be like the highest.
At some point, but then I think it's just been at a decline for a while now. In terms of AUM, like I think overall performance wise is doing pretty well.
Gotcha. So let me just double check. I think it's 56. Yeah, I think it's 50. Oh wait, I think it's about 50 billion. So income is actually, yeah, income is twice total return now. That's insane.
Okay, thank you.
Oh, okay, my bad. Income is 113 billion. That's insane. And total return is about 50 billion. And then dynamic bond is 2 billion, so it's like a way smaller fund. But yes, so just going back into my slides.
Hi, Thera, I have a question.
Yeah.
So circling back to your earlier question on especially since you said you are looking at the retirement portfolios of plans or advisors, do you see the combination of income and DBF, or is it usually just income?
That's actually a really good question, because that's exactly what I wanted to talk about later. So yes, actually that's something that we've been trying to kind of convey across the firm, that DBF and income should be the two funds that people should think about investing together. Because if we think about portfolio construction wise, we can see very clearly that income has a lot more risk into the portfolio in terms of their high yields, right? They have more credit risk. And then they also have higher, like, exposure to like government related, which is very minimal, but it used to be a lot bigger. So they're more sensitive to interest rates pretty much. And then they have, more, I would say, more risky sort of like investing strategies, just because they need to pay that fixed distribution every month. And I actually just learned this last week, but if they don't make enough money per month to pay that distribution amount, so already there's like a bench line, like even if you make negative returns, you still have to make a particular small amount of money to be able to pay that distribution. And if you're not able to pay that distribution, you have to kind of send a notice out to like every single investor in that fund. So even if you have like one unit in that fund, like you're going to get a notice that said this fund did not perform enough to get to give you this distribution that you are now receiving, right? And so the fund is taking on a lot of risk because it's under so much pressure to have to provide that distribution. And so even if it's not performing well in the government related, securitized, IG, high yield, whatever, it does need to have like 5%, let's just put it like hypothetically cash, just so that the cash can perform well enough for it to pay that distribution, right? And so there's a lot of, I would say, less flexibility, but more pressure for this fund to have to perform, compared to like DBF, which could be a defensive mechanism for income, because there's less credit risk, there's less duration risk, but at the same time, this fund could also stand on its own by providing like an extra, like I don't even know the word right now, but kind of like an extra sprinkle of returns for your portfolio, right? And so in retirement portfolios, we usually will always see income, but increasingly we are starting to see clients pair that with DBF, so as to reduce the amount of risk that that fund is undertaking, right? Because income, I believe, is down like 10% this year, but DBF is only down like 6%, right? Because DBF is so much more flexible that they can invest in pretty much every single area, because they don't need to perform that distribution. And so even if income goes down, then you still have one fund that's still doing better. So you're still able to provide some form of return back to investors. I hope that
Yeah.
answers your
Yeah,
question.
absolutely. Thank
Mhm.
you.
Yeah, so I'm just going to, so if anyone has any like more questions on asset allocation, feel free to just shout them out. Like this is probably like my favorite part of my presentation. And let's go into kind of the last bit. So this is the PIMCO income fund. There we go. Just kind of showing you the breakdown. This is actually as of August, I believe. So just going through like products in fixed income and what you could find. You can see treasuries, obviously very safe, very reliable. Munis, again, very safe, very reliable. Tax exempted as well. So that's kind of like their draw. And then we see sovereign non-US denominated bonds. So we can see that like PIMCO will invest in like Thailand, Singapore, all these countries that they deem very safe, and also will allow them to generate consistent returns. Having said that, though, they can, in terms of like non-US denominated bonds, it also provides you an opportunity to short, right? So let's say I don't think the fund is doing this, but like let's say I have very low conviction on like Italy or something because it has so much volatility in terms of like its geopolitical landscape, or it's not doing well, it could go bankrupt at any moment. Like if I were a fund like DBF that could do anything, I would think about potentially shorting like Italy, Brazil, Argentina, these countries that are doing poorly in terms of just how they're compared to a global market, they're not doing as well, right? And then obviously corporate credit, we have investment grade and high yields. I would say for like investment grade and high yields, you can even break it down into sectors, into what you're thinking. And so different funds will have different guidelines into what sectors they're able to invest in. I think Irvi can also chime in as to like total return into like what sectors they were investing in. But like, I think PIMCO, like for income fund, they have like a preference to invest in like gaming or like lodging or hospitality this year from like the reopening. So that's something that's really interesting to think about, right? It's like, you invest in these types of corporate credit, but it's also dependent on which sector you're investing in terms of trying to find those returns. You can invest in like hospitality and do super well in 2022, or you could invest in like tech or something which hasn't been doing well at all, right? So that's something that we need to think about in constructing a portfolio for fixed income. And then another one that's really interesting for me is tips. I feel like PIMCO as a firm has a view on tips, which most of the PMs don't actually follow, because the 4 funds that I cover all do very different things with tips. I have one fund that's like has super high exposure to tips, and then one that's shorting tips, one that has like kind of a small exposure but not super like large, and then there's one that doesn't invest in tips at all, which is kind of funny, right? Because of the environment that we're in, we think that everyone would want to go into treasury inflation protected securities given how high inflation is right now. But yeah, the truth is with like tips, it only really performs well in if the actual inflation is higher than the break-even inflation, which I guess in this environment it is. And so we can see that like funds are I don't want to say people have gotten inflation wrong, but I would say that a lot of people expected inflation to be transitory rather than, much more sticky than it is now. And so adding these positions at a later time means that it's more expensive for the fund. And so right now you're probably wondering, oh, if we know inflation is going to be very sticky, then why are we not buying more tips? Well, I guess at this point, because tips is probably, what everyone's after, it's a lot more expensive and it's not as economical now for you to be adding in tips into the fund anymore. It's just not as attractive as an investment, right? You want to go into positions relatively cheap. And so with that, you're thinking into other areas, unless you think, inflation is going to overshoot 11%, then you're like, okay, even right now, I would still go into tips, right? But at this point in time, it's not the most economical decision. And then obviously we have credit default swaps, which is, I'm pretty sure Irvi can explain this way better than I can, because I know that the portfolio team works more on options and swaps. But credit default swaps, if anyone is unaware, it's basically when you buy insurance on a bond, and when the bond fails, or in any security really, when it fails, it pays out. So it's like a swap, right? And so you're kind of exchanging the cash flow. And then you have securitized agency, which is kind of backed by like Fannie Mae, Freddie Mac. I hope I'm saying that right. Is it Freddie like, yeah, the government related Fannie Mae, I believe it's Fannie Mae.
Yeah.
Okay.
Yeah.
And then, yeah, I always get those two confused, Fannie Mae and Freddie Mac. And then non-agency, which is more on the private side, MBS. And then you have asset-backed securities or residential mortgage-backed securities, which has actually been doing relatively subpar compared to how well the mortgage market has been. Well, I mean, I guess it's because interest rates have gone up, so mortgages have become more expensive. But yeah, definitely looking towards like securitized credit to find other avenues of revenue. And there are actually some funds in PIMCO that are considered fixed income, but only invest in securitized. So Arvi, I don't know if you know the Mortgage Opportunity Fund, MOF, that only invests in securitized. And so I think if we just look into products in fixed income, there's actually a lot of versatility and diversity into what you can invest in. And I didn't include it here, but you even have like structured notes, which, you know, like I said, can go into convertible bonds, which can be converted into like preferred equity shares, or it could even be like an option that will convert into commodities. Like you can even convert like this bond to like almonds or something. Like, you know, it's very flexible, and there are so many things that, you know, you can kind of go about in fixed income. I think it's kind of gotten a little bit more of a conservative rep, that it's like a little bit, you know, not as sexy as like equities or commodities or like Bitcoin, but I think there's still a lot of versatility and a lot of opportunities to be found in this space. So last but not least, I just kind of want to make a little bit of a small point into like fixed income in this particular environment and looking at like cyclical outlooks and stuff. So, you know, we can see that now with the rising rates, like fixed income can probably deliver more returns than they did back in like 2020. But we're not just focusing on like higher yield and higher yielding fixed income, but we're looking towards higher quality as well, right? Like in this volatile market, you want to make sure that your investment is resilient enough to make it through this volatility. So you don't want to focus too much on just your yields and everything. You want to focus on providing quality and flexibility into your portfolio. And then we're looking at kind of like the front end yield curves is, you know, pricing in monetary tightening. So we see more opportunities to harness the front end of the yield curve. So basically what this means is that we see a lot of front end yield curves pricing in more rate hikes. And so there's more opportunities in the near term to get higher yielding like bonds if you are buying short duration. So like I said, a lot of funds right now would buy short duration rather than long duration. Funds might even short longer duration, right? Because you're getting more yield at the beginning of the curve compared to the end. Given that the curve, I believe, might even look a little bit flat now too. And then the third and last point is kind of investors can combine high quality benchmark yields with select exposure to high quality spread sectors. And so this is basically like similar to what I said about income and DBF. Like you can, you know, look at higher quality portfolios like DBF and combine that with a fund that has higher credit risk, but they're able to yield more. So it's kind of just looking for opportunities to combine funds rather than sticking to just one fund, and obviously adding active management in there just because like passive investment just hasn't been doing as well as it was previously, like I said, with the ag. And then last point on inflation, I think everyone's kind of like on edge about inflation. And so we probably won't see the Fed cut rates until like 2024, I believe is my guess, because a lot of investors are now anticipating that the Fed will still continue to hike rates well into 2023, maybe at the beginning, like quarter of the year, that's for sure. And so I think that's something that a little bit that has thrown off people a little bit more, just because inflation doesn't do well with bonds and stuff, but it also means that financial conditions are going to tighten a lot more. And so I think, again, it's just emphasizing higher quality assets like investments into your fund and looking for value where you can find them. So I guess instead of like, you know, looking for the highest yielding asset, I think you're trying to look for value and looking for quality. And so making sure that you're emphasizing resilience and flexibility into your portfolio to be able to ride out this volatility through. And then after that, you can kind of just be a little bit more, flexible and free into whatever you want to do. So I believe like there's one BlackRock like fund that I worked on, like FIGO, the Fixed Income Global Opportunities Fund, that like invested in equities last year as well, just because equities was doing so well, right? But that's something that they have to cut down this year because equities are not doing very well, and that's going to be a drawdown on the fund. And so once kind of this tumultuous period kind of passes through, then you can think about, adding that extra diversification in again. And so right now it's more of just trying to make sure that your portfolio is going to make it through intact, because there are actually a lot of funds that have been going kind of, have been closed and everything just because of the market. And so, yeah, I think this kind of concludes my presentation. We have like 3 minutes left, so I don't know if anyone has any questions or any thoughts.
Thank you so much. This was super helpful and informative.
Thank you. So if not, I'll pass it back to Irvi in case Irvi has any final thoughts.
Yeah, no, thank you so much, Thera. I feel like I learned so much about the funds I worked on. I used to work on the Dynamic One Fund, DBF, and Total Return Fund. So this was definitely super insightful and a great throwback for me. For the munis aspect, I thought I'd like add a few more comments on that, because I remember we talked about it briefly, and I think it's a product type that I think a lot of the time gets neglected. But I started working on the desk earlier this year, and I worked on the desk for about like 5-6 months, and I thought like I'd share like how the munis in the next coming year would do significantly better than they have been so far, and municipals and what exactly they entail, because I think I personally had a lot of misconceptions about it. So like 2021 was actually a massive year of inflows for the muni market. And that led to like very tight valuations. Everything was super oversubscribed. And then coming to 2022, they experienced some sort of like 20 billion outflow in the market, which kind of threw it off. Like the PIMCO Muni Fund, for example, was down 60% back in April, which was crazy to be on the desk at that time, I think. But now I think that given that there's an increase in supply in the horizon, especially given the infrastructure pressures that we're experiencing post-COVID, all of that is putting a downward pressure on the muni prices. So muni indices are now down between like 6 to 8% at the start of the year, which was essentially the worst start of the year in the past 40 years. And that was exactly how significant the crunch in the muni market was. But now, like some of the sectors that a firm like PIMCO is looking at is like prepaid gas, which is offering extremely attractive valuations. So like the gas company in California, for example, would be something that I know that the Dynamic One Fund publicly holds like on Bloomberg. So like opportunities like that, I think will turn the muni market around like it has never been before, and will definitely be a place where I think I'd imagine that more funds would look into investing into. Like, for example, the fund I work on currently doesn't even touch munis, because it's just a place, it's quite a niche right now, I think, but soon I think it would be a place that every fund would be wanting to be a part of. And then another fun fact, like because munis offer this tax-free advantage, and especially like regions like California and New York where taxes are something I hate talking about. A lot of like the rich fund managers at a lot of firms that don't need to necessarily name invest their money through the munis there, which means that they can essentially quote unquote like circumvent the tax aspect by investing in like publicly funded investments like the Water Board of Chicago or things like that. So I think pretty interesting. Happy to talk about it more. It's something I like talking about. But anyways, thanks so much, guys. Thank you so much again, Thera. This was super, super helpful. I really appreciate all the time and effort you put into making this presentation and walking us through this. I found it super insightful, and I think everybody else did too. So thank you.
Thanks, Urvi. Yeah, no, happy to do it and happy to shine more light into DBF. I think it's not a very well-known fund that could go as well. So, but yeah, sorry, I think I interrupted someone.
Oh, no, I was just saying it was a very nice presentation. Really insightful. Thank you.
Yeah, and I think Urvi has my contact. So if anyone wants to reach out or like set up a call for like a coffee chat, like happy to talk. And yeah, I hope everyone is enjoying their weekend. So I think I hope I covered everything, and then Urvi has the slides as well. So if you guys want the slides, Urvi has them.
Yeah. If nobody has any more questions, I think we can call it a day for now. Yeah, thank you so much, and see you guys next week. Bye.
Thank you. Have a good weekend.
Thank you.